Question 871. A wife is signing an agreement to purchase property as separate, rather than community, property. The husband is: A. is required to sign the purchase agreement, B. is not required to sign the purchase agreement, C. can block the purchase of the separate property, D. all property purchased by a spouse, separately or together, is considered community property. Correct answer is B. is not required to sign the purchase agreement. In community property states like California, separate property is owned individually by one spouse. Each spouse has sole management and control over their separate property. The purchase agreement outlines the terms of the acquisition. If the property is being acquired using separate funds and intended to be separate property, it is the purchasing spouse's individual transaction. The deed would then be recorded in her name, typically stating, as her sole and separate property. When a husband's signature is typically required: 1. If the property being purchased is intended to be community property, and especially if it involves a loan where both spouses' income, credit are considered. 2. If a spouse uses community funds to purchase property intended as separate property, a distinct written transmutation agreement is required. This agreement must be signed by both spouses to formally change the property's character, and it is separate from the purchase agreement itself. 3. If the couple were selling a community property asset, both spouses would need to sign the deed. Therefore, for the act of purchasing property designated as separate property with separate funds, the non-purchasing spouse's signature on the purchase agreement is not required. Question 872. Leases with rent based on the gross sales of a business are called: A. gross lease, B. percentage lease, C. sales lease, D. total receipts lease. Correct answer is B. percentage lease. Sales lease and total receipts lease are not commonly terms used in real estate. In a gross lease, the tenant pays a fixed rent amount, and the landlord is responsible for paying property taxes, insurance, and maintenance costs. A percentage lease is a type of lease where the tenant pays a base rent plus a percentage of their gross sales. This type of lease is commonly used for retail properties, as it allows the landlord to share in the tenant's success. Question 873. A buyer can choose to work with agents in the following types of representations: A. exclusive buyer agent, B. non-exclusive agent, C. dual agent, D. all of the above. Correct answer is D. all of the above. A buyer can choose to work with agents in several types of representation models, depending on their needs and the laws of their state. Let's break down each option. A. An exclusive buyer agent. The buyer enters into an exclusive agreement with a specific agent. This agent represents only the buyer's interests and is typically paid a commission, often derived from the seller's proceeds, but the buyer's agent still owes fiduciary duties only to the buyer. The buyer commits to working solely with this agent for a defined period or until a property is purchased. B. A buyer might work with an agent on a non-exclusive basis. This means the buyer is not tied to one agent and could potentially work with multiple agents, or even purchase a property independently without owing a commission to that specific agent. The agent still represents the buyer's interests when acting on their behalf, but the commitment is less formal or exclusive. C. In a dual agency situation, one real estate agent, or brokerage, represents both the buyer and the seller in the same transaction. This type of agency is legal in many states, but requires full disclosure and the informed written consent of both parties due to the inherent potential for conflicts of interest. The buyer specifically chooses to accept this form of representation. Since a buyer can legally choose to work with an agent under any of these established agency relationships, the correct answer is D. all of the above. Question 874. The documentary transfer tax is: A. usually paid by the seller, B. does not apply to real property sales under $100,000, C. listed in the settlement statement, D. Both A and C. Correct answer is D. Both A and C. While the party responsible for paying the documentary transfer tax is negotiable between the buyer and seller, it is customarily paid by the seller in California. Documentary transfer tax generally applies to transfers of real property where the consideration or value of the property conveyed exceeds $100. The rate is typically 55 cents for each $500 of value, or fraction thereof, or $1.10 per $1,000 of value. All closing costs, including the documentary transfer tax, are itemized and listed on the settlement statement. Now commonly the closing disclosure under TRID rules. Therefore the most comprehensive correct answer is D. Both A and C. Question 875. Something that is inherited is referred to as an A. Appurtenance, B. Reliction, C. Hereditament, D. Bailment. Correct answer is C. Hereditament. Appurtenance refers to something that belongs to and passes with the land, such as an easement or a right-of-way, but isn't the general term for anything inherited. Reliction is the gradual recession of water from land, exposing new land. It's a method of land acquisition, not a term for inherited property. Bailment is the temporary transfer of possession of personal property from one person to another. It has nothing to do with inheritance. A hereditament is any property, whether real or personal, that can be inherited. The two types of hereditament are corporeal and incorporeal. A corporeal hereditament is a tangible object confined to the land, such as coal, timber, or a house. An incorporeal hereditament is an intangible right derived from real or personal property, such as an easement. Question 876. A group of brokers agree to divide a market area into separate sections where only one broker each will be allowed to operate. This is illegal, because it only affects the brokers themselves. B. Illegal, because brokers can only divide a neighborhood in thirds. C. Illegal, because it violates antitrust laws. D. Legal, because no consumer is harmed. Correct answer is C. Illegal, because it violates antitrust laws. The described action is known as market allocation or territorial division, where a group of brokers agrees to divide a market area into separate sections for exclusive operation. Market allocation is a per se violation of federal antitrust laws, like the Sherman Antitrust Act, and similar state laws, like California's Cartwright Act. It eliminates competition among brokers, limiting consumer choice, potentially leading to higher prices, and reducing the quality of service. The law presumes that such agreements are inherently harmful to competition, regardless of whether direct consumer harm can be proven in a specific instance. Such agreements are illegal and can result in significant penalties for the brokers involved. Question 877. After a buyer gave a deposit to a broker, the seller did not accept the buyer's offer. However, the broker subsequently did not return the deposit to the buyer. In such a case, the real estate commissioner will A. Immediately suspend the broker, B. Investigate, upon receiving a verified, written complaint, C. Do nothing, D. Report the matter to the police. Correct answer is B. Investigate, upon receiving a verified, written complaint. The DRE's primary role is to enforce real estate law and protect the public. They have the authority to investigate complaints against licensees. The DRE typically requires a formal, written, and verified complaint from the aggrieved party, in this case, the buyer, before initiating an investigation into a licensee's conduct. If the investigation finds evidence of a violation, the commissioner can then take disciplinary action against the broker, which may include license suspension, revocation, or a monetary fine. Immediate suspension is rare and usually reserved for cases where there's a clear and immediate danger to the public. It's not the first step for every complaint. For serious violations like misappropriation, the Real Estate Commissioner's initial step is to launch an investigation from a licensing and regulatory perspective. Although criminal charges are possible in severe instances, the Commissioner's primary focus is on addressing the breach of real estate law through administrative discipline. Question 878. The separate property of a married person includes the following. A. Property acquired during marriage by gift. B. Property acquired during marriage by inheritance. C. Property acquired with the proceeds from the sale of separate property. D. All of the above. Correct answer is D. All of the above. Separate property is property that is owned by one spouse and is not considered community property. In California, which is a community property state, the law distinguishes between community property and separate property. Separate property of a married person includes A. Any property received by one spouse as a gift during the marriage is considered their separate property. B. Any property received by one spouse through inheritance, bequest, devise, or descent during the marriage is also considered their separate property. C. If a spouse sells their separate property, the funds obtained from that sale remain separate property. Any new asset subsequently purchased using those traceable funds also retains its character as separate property. This is often referred to as tracing. Since all of these scenarios describe property that is legally considered the separate property of a married person, the correct answer is D. All of the above. Question 879. The deadline for a broker to deposit a client check made out to the broker's trust account is A. 3 business days. B. 5 business days. C. A week. D. There is no such deadline. Correct answer is A. 3 business days. In California, real estate brokers are strictly regulated regarding the handling of client funds. When a broker receives a client check made out to the broker's trust account, they are required to deposit those funds promptly. The deadline for a broker to deposit a client check made out to the broker's trust account is 3 business days. This rule is stipulated in the California Business and Professions Code. This ensures the timely and proper handling of client money. Question 880. If a party to a contract unintentionally provides false information that leads the other party into agreeing to the contract, it is called A. Misrepresentation. B. Fraud. C. Dereliction of duty. D. If the mistake is unintentional, then the contract will be enforced. Correct answer is A. Misrepresentation. Misrepresentation occurs when a false statement of a material fact is made, which induces another party to enter into a contract. It can be innocent, unintentional, negligent, made carelessly without reasonable grounds to believe it's true, or fraudulent, made intentionally to deceive. Since the question specifies unintentionally, it falls under the umbrella of misrepresentation. Fraud specifically involves intentional deception or reckless disregard for the truth, with the aim of inducing another to act. Dereliction of duty refers to a failure to fulfill one's obligations or responsibilities. While an unintentional misrepresentation might stem from a lack of due diligence, a form of dereliction, misrepresentation is the specific legal term for the act of providing false information in contract law. Even unintentional, innocent or negligent, misrepresentation of a material fact can make a contract voidable by the misled party, as it affects the genuine consent of the parties.